looking to continue. We're very focused on really working with tier one telecom operators and increasingly data center companies globally. We're within our markets disproportionately focused on Europe and US segments, which are currently contributing to about 75% of our revenue. So we do expect that kind of ratio to continue both in terms of our order book as well as revenue. In terms of the mix, certainly we are starting to see that what we call the enterprise and data center business contributing to about 20% of our revenue. And we do see that directly or indirectly, whether it's telcos supplying fiber, dark fiber to data centers or data centers themselves deploying optic fiber and connectivity solutions, both of this will lead to this ratio of 20% increasing as we go forward.
Let's talk about your margins. The optical business margin was impacted this quarter due to tariffs. Now, what is the company's view on how much of this headwind is one-off versus structural? And
I think, look, the way we are structured is quite good. We have a very strong home manufacturing base in India. We're fully integrated from glass to fiber to cable and now connectivity. We also have very strong operations in China, in Italy, as well as in the US, where we have a state-of-the-art cable facility. So the way we serve currently, particularly the US market, is both manufacturing from India and as well as certain products and solutions from our US facility. So I think it's really going to be a function of what kind of demand and what kind of customers we take up in the coming quarters. We've got very good demand and brand visibility now in the US market, and we're looking to scale that up. Certainly, this full quarter, we are going to be impacted in the current quarter at the full 50% rate. So there will be a continued impact of tariffs in our numbers. What we've showcased currently is that even in the quarter two, we would have been north of 16% EBITDA, but we had close to about a 3% impact on our EBITDA linked to the tariffs.
All right, but along with that, Ankit, let's talk about your utilization levels, because capacity utilization was flagged as a key lever for the margin improvement. What's the current utilization rate across optical fiber, cable manufacturing, and what target utilization level are you looking forward to for the full year 26 and FY27?
So we won't share specific numbers, but broadly, we had been talking about a journey. We are going from about 50% utilization levels towards 80% utilization levels. That's the journey we continue to be on. I think month on month, our performance and operations are improving. That will also impact us and benefit us from the cost of operations as we spread out our fixed costs. So we clearly continue to be confident at that 80% utilization levels, we will achieve 20% EBITDA margins. And we do see that happening between quarter four and quarter one, which is coming up. So I think in summary, I think we're seeing good order books. We are getting impacted by tariffs, but certainly from a top line perspective and continuity perspective, things will improve. And we are also hoping, given everything we're seeing in the media, that some element of BTA does get signed in quarter three, and we do see the benefit of that in our quarter four.
All right, Ankit, good luck with that. And with that, it's also time to sign off. Thank you so much for taking time out and talking to ET Now today.
Thank you.
So that was